What are liabilities on a company's balance sheet? Imagine trying to understand how financially healthy a company really is. One key piece of that puzzle is knowing what the company owes to others. That's where liabilities come into play. They are the debts and obligations a company must pay in the future. These can include money owed to suppliers, lenders, or even employees and government agencies. When you look at a company's balance sheet, liabilities are listed alongside assets and shareholders' equity. They follow the fundamental accounting equation: assets equal liabilities plus shareholders' equity. Liabilities are mainly divided into two groups. First are current liabilities, which are debts due within 1 year. Think of bills like accounts payable, which is money owed to suppliers for goods or services already received. Short-term loans and wages payable are also current liabilities. Taxes owed to government agencies and credit card debts fall into this category too. These short-term obligations are important because they show how well the company manages its cash flow and liquidity. If a company has too many short-term liabilities compared to its assets, it might struggle to pay its bills on time. The second group is non-current liabilities, which are debts due after more than 1 year. These include long-term loans, bonds payable, and mortgages. Lease obligations and pension provisions also fall into this category. These long-term debts influence how much leverage a company has and can impact its risk profile. For traders and investors, understanding these long-term obligations helps assess whether a company is financially stable or overly reliant on debt. On the balance sheet, liabilities are usually listed on the right side or below assets if it's a single-column format. They are often shown above shareholders' equity because creditors have priority if the company liquidates. This placement shows that debts are a primary claim on the company's resources. From a market analysis and trading perspective, liabilities matter a lot. The debt ratio, which is total liabilities divided by total assets, indicates how much leverage a company uses. A higher ratio suggests more debt and potentially higher risk, which can lead to more stock price volatility. Companies with large short-term liabilities might face liquidity issues, affecting their ability to meet obligations and impacting stock performance. Long-term liabilities influence future cash flows because of interest and repayment obligations, which are key in valuation models used by traders. Changes in liabilities over time can also signal strategic moves. For example, a company taking on more debt to fund growth might be seen as bullish or bearish depending on the context. Overall, liabilities on a balance sheet are a clear indicator of a company's financial commitments and risk level. They help investors and traders gauge the company's stability, leverage, and future prospects. Understanding liabilities is essential for making informed decisions in stock trading and options strategies.